some important global stories. Of course, the FOMC outcome. As expected, the US Federal Reserve, they kept the policy rates unchanged at 5.25% to 5.50%, and this is for the third straight meeting. But looking at the commentary, they hinted at a softer approach for the year ahead. Now, Chair Jerome Powell, he hinted that they expect the third quarter point reduction to the benchmark interest rate next year, even as some economists, they were betting on a more aggressive stance. So Powell also said that the Fed is now seeing progress on the inflation across the three main core areas.
We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. Expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing. We're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table.
And after the Fed's forecast for rate cuts, Jeffrey Gundlach also expects the 10-year Treasury yield to continue to fall to the 3% range next year. In an interview, the Double Line Capital CEO said bonds will continue to rally, and if the 4% level is broken on the yields, then a fire alarm would go off relative to the economy. Projections released by the Fed showed the central bank would slash rates to a median 4.6% by the end of 2024. But he also believes that it's unlikely that the central bank would reduce borrowing cost by that much next year.
And even if the US may be banking on a soft landing, the picture is not so optimistic for the UK because the GDP contracted by 0.3% past October. And this dip is signaling a worrisome start to the final quarter of the year, raising concerns that the economy might not just be cooling as yet, but actually shrinking. And the decline that was largely led by a broad-based slowdown across sectors, the crucial service sector, the heart of the UK economy, that took a hit, as did the manufacturing sector. Now, consumers already squeezed by the soaring prices as well as the stagnant wages, they are cutting back on the spending, which only adds to the economic woes.
And Chancellor Olaf Scholz's three-party governing coalition has struck a deal on spending for 2024. It comes after a court ruling threw the government's finances into disarray and exposed deep rifts between the parties. The government is expected to save 17 billion euros in its core budget by ending climate-damaging subsidies and cost-cutting. He also added that the government was sticking to its goals, including supporting Ukraine.